Inventory accounting is a fundamental aspect of any business that deals with physical goods. Imagine walking into a store filled with products, each one representing a significant investment of time and money. This inventory is not just a collection of items, it's a critical asset that can shape the financial health of a company. That's where inventory accounting comes in. It's the process of recording, classifying, and summarizing inventory data for financial reporting purposes. The goal: to provide accurate and timely information about a company's inventory levels and value, which is essential for decision making, tax planning, and financial reporting. Let's break it down. The first step in inventory accounting is conducting a physical count of the inventory. This count should happen at least once a year, but if you have high inventory turnover, you might need to do it more frequently. Think about it. If you're selling items quickly, you want to ensure your records reflect what you actually have on hand. The physical count needs to be done by trained personnel using proper counting procedures. It's about accuracy, and accuracy is paramount when it comes to financial reporting. Once the physical count is complete, the real work begins. The data must be classified and summarized. This classification isn't just a random grouping, it should cater to the specific needs of the business. A well-designed classification system can help streamline decision-making processes. The summarized data should be presented in a way that's easy to understand because, let's face it, nobody wants to sift through mountains of numbers without context. Now, the inventory accounting process isn't a set-it-and-forget-it deal. It requires periodic reviews to ensure it remains effective and efficient. Businesses evolve, inventory levels change, and the needs of information users shift. Regular reviews help identify areas for improvement, ensuring that the inventory accounting process continues to serve its purpose effectively. So, how does inventory accounting work in practice? Under generally accepted accounting principles, inventory must be properly valued. Why? Because inventory is an asset that significantly impacts the bottom line. Misstating inventory can lead to overstated profits or an inflated company value, which can have serious repercussions. Understanding how inventory accounting works is crucial for maintaining accurate financial statements. There are two primary methods of inventory accounting: first in, first out, and last in, first out. FIFO assumes that the oldest inventory is sold first. This means that the cost of goods sold is based on the cost of the oldest inventory on hand. On the flip side, LIFO assumes that the newest inventory is sold first, which means that COGS is based on the cost of the newest inventory. Whichever method you choose, it's important to apply it consistently to maintain accurate financial statements. Now, let's talk about the advantages of inventory accounting. One of the most significant benefits is that it provides a more accurate representation of a company's financial health. This accuracy allows businesses to assess where they can increase profit margins on products. With this information, companies can make strategic decisions regarding pricing, production, and marketing. In essence, inventory accounting is a powerful tool that can help businesses improve their bottom line. But how do businesses implement effective inventory accounting practices? There are some essential guidelines to follow. For starters, every department that generates revenue from selling products should maintain inventory records and conduct a physical inventory at least once a year. Inventory is any physical property, merchandise, or sales item held for resale, and it must be recorded as an asset on the balance sheet. The purpose of conducting a physical inventory is to verify the accuracy of the inventory records. This involves counting all items in the inventory and comparing the count to the records. Any discrepancies should be investigated and corrected. Additionally, departments must ensure that all inventory items are safeguarded from loss or damage. It's about protecting your assets. Now, let's dive into the steps of the inventory accounting process. First up is establishing an inventory tracking system. This system is crucial for any business that sells physical goods. By tracking purchases and sales, businesses can calculate their goods costs more accurately. Object codes can help identify inventory purchases and sales efficiently. This tracking ensures that businesses avoid overspending and make informed decisions about pricing and purchasing. Next, you need to establish physical inventory controls. Limiting access to inventory and implementing procedures for receiving and shipping are key components of this step. It's essential that employees responsible for inventory control are knowledgeable about the products being inventoried. High-dollar items should be secured, and storage areas should be locked when operations are closed. Proper labeling and organization of inventory can help you quickly access items and determine the quantity on hand. When it comes to purchasing and receiving goods for resale, following the correct procedures is essential. Goods should be purchased through a structured purchase order process. When goods are received, it's vital that the packing slip matches the invoice and the materials received. This ensures that the inventory records are accurate from the get-go. Inventory purchases are recorded as a charge on an inventory object code in the sales operating account. Recording transactions for goods sold is another critical step. When goods are sold, it's essential to accurately record the transactions, and ensure that the right items are billed and shipped to customers. Sales should be recorded in the operating account with the appropriate sales object code. This step is crucial for maintaining accurate financial records and ensuring customer satisfaction. Calculating and recording the cost of goods sold is vital for understanding profitability. COGS is calculated using the formula beginning inventory plus purchases, ending inventory equals cost of goods sold. Profit, in turn, is calculated as sales, cost of goods sold equals gross profit. It's essential to use the same period for all calculations, whether weekly, monthly, quarterly, or yearly, to ensure accuracy. Performing a physical inventory might seem tedious, but it's essential for ensuring the accuracy of financial statements. The physical inventory provides information on each unit's cost of goods sold, revenue, and profit, all of which impact the financial statements. This process should involve at least 2 people to ensure accuracy, and a third person can spot check completed inventory sheets. Once the physical inventory is complete, the next step is adjusting the general ledger inventory balance. At the end of each accounting period, businesses must compare the physical inventory count to the inventory book balance tracked by their inventory tracking system. If there's a discrepancy, the general ledger must be adjusted to match the actual inventory count. This step is crucial for maintaining accurate financial records. Now, let's talk about correcting inventory shortages and overages. If your records indicate that you have fewer items on hand than you actually do, you have an inventory shortage. To correct this, you need to adjust the balance on the inventory object code and increase the balance on the inventory over short object code in your sales operating account. On the flip side, if you have too much inventory, you'll need to increase the balance on the inventory object code and reduce the inventory over short object code. Finally, let's touch on inventory devaluation. This occurs when the value of goods not sold decreases over time. In this case, you would reduce the inventory object code and increase the cost of goods sold object code in the sales operating account. It's a necessary adjustment that reflects the reality of your inventory's value. In conclusion, inventory accounting is a comprehensive process that helps businesses track the quantities of finished goods available for sale. It's a critical system for managing production levels and purchasing decisions, ensuring that businesses have enough inventory to meet customer demand. By establishing an inventory tracking system, implementing physical inventory controls, recording transactions accurately, and performing regular physical inventories, businesses can maintain accurate inventory levels and make sound decisions about their operations. Effective inventory management is essential for any business that sells physical products. It helps avoid stockouts and costly overages, ensuring that companies can meet customer demands while managing their investments wisely. In today's fast-paced business environment, having a robust inventory accounting process in place can make all the difference between success and failure. So, whether you're a small business or a large corporation, understanding the ins and outs of inventory accounting is crucial for your financial health and overall success.